Well, the One Big Beautiful Bill Act is here. And so is the noise, my friend. There's opinions, there's confusion, there's hot takes, and also there is a lot of contradictions. But underneath all of it, I keep noticing something that has nothing to do with the bill itself. You see, if you really stop and think about it, every time Congress changes the tax law, business owners, they see the tax law change and they start asking some, same basic questions. Hey, should I buy equipment? What about my entity? Should I change my entity structures? Maybe it's time to hire someone. Now, my friend, these aren't bad questions. They're just not the first questions that I believe you should ask. So here's what we're going to do today. I'm going to give you 4 questions. Now, these 4 questions they'll work for this bill, they'll work for the last bill, and they'll work for every other bill that's going to come after this. And we're going to run the One Big Beautiful Bill through all 4 of them and give you the answers that you need. By the end of our conversation, my friend, you won't just know what changed, you're going to know how to think about it. Hey there, my friend. Welcome to the Growth and Wealth Podcast. I'm Rodney Boswell. So instead of asking what's in this bill, I'd like to encourage you to ask 4 different questions. Now, these questions are questions that intentional builders ask whenever the tax law changes. First question, does this build more capacity? You see, when Congress creates a new tax incentive, most business owners, they immediately ask, well, how much can I save? Now look, it's a fair question, but I don't think it's the first question. The first question should be, does this investment actually increase the capacity of my business? Because that's ultimately what determines whether the investment actually creates value. One of the biggest provisions in the One Big Beautiful Bill is the return of the 100% bonus depreciation. Now, the bill also expanded Section 179, and that allows many small businesses to immediately expense some more qualifying business property. Now, if you're listening to this news, these 2 provisions almost sound identical. They both do what they call accelerate deductions. They both reduce taxable income immediately. They'll both create meaningful tax savings. They both will do all of these things, but they're not the same. And understanding the difference can help you make better decisions. So let's use a simple example, and that way we can go through this together. Look, suppose your business is considering purchasing a piece of equipment that costs $200,000. Maybe it's a new piece of manufacturing equipment. Maybe it's a new heavy machinery. Maybe it's a vehicle. Maybe it's technology that allows your team to become more productive. But under the One Big Beautiful Bill, that purchase may qualify for what they call immediate expensing. Now that's exciting, right? But here's where business owners need to slow down and take a little bit of time to really think. You see, with 100% bonus depreciation, you may be able to deduct the entire purchase this year, right? And in the right situation, that deduction could actually create a business loss. Depending on your overall tax situation, that loss may reduce other taxable income on your tax return this year. Now that can create a significant current year tax benefit. When you take a look at the Section 179, you'll find that it works a little bit differently. As a general rule, the Section 179, it cannot create nor can it increase a business loss. So if your Section 179 deduction is larger than your business income, what happens with it is the unused deduction doesn't disappear. You don't lose it. It just carries forward into future years where it could possibly offset future business income, when your business has enough taxable profit to use it. Now, I'm not telling you this because I want you to become a tax expert. Leave that up to the tax experts. Hey, my friend, I'm telling you this because I want you to think about it like a leader. So let's imagine the 2 different business owners. The first owner had the most profitable year in his company's history. His revenue exceeded his expectations. His profit was up. Man, they were having a phenomenal year. Cash flow was strong. Man, so reducing the taxable income this year could create tremendous value for this business owner. The second owner, in his case, is growing rapidly and they're investing heavily. This year's been a good year. Business is growing, but they're standing here looking at the future, and next year actually is beginning to look even better. Revenues expected to increase, profitability is expected to improve. So for that owner, having the deductions available in the future may actually be more valuable than using every deduction today. Look, it's the same purchase, it's the same law, but it's two different businesses with two potentially very different strategies. So that's why tax planning is never just about finding the biggest deductions. It's about finding the right deductions. Look, it's about finding the right time. It's also finding the right reasons. So before either owner, they sign on the purchase agreement, I want to ask them, and I would ask them one more question. Look, if there were no tax deductions at all, would you still buy this piece of equipment? Would it increase your production? Would it help you become more efficient? Would it reduce your labor cost? Could it potentially create additional revenue for your business? Would it help your team serve your customers better? Now, if the answer to this question is yes, my friend, the tax deduction simply lowers the cost of making a smart investment. I want you to think about that. But on the other side, if the answer is no, no deduction will ever turn a bad investment into a good one. I want you to think about that. And that's why intentional builders don't ask, can I deduct it? They ask, does this investment increase the capacity of my business? You see, capacity creates opportunity. And capacity is what allows business owners to grow intentionally rather than simply just getting bigger. Now, building capacity is important, my friend. I think you would fully agree with that. But eventually every business owner has to answer the second question. Is my business simply generating income, or is it helping me build lasting wealth? And that's the question we want to tackle next. Now, building capacity is important, but eventually every business owner's got to answer that second question. Is my business simply generating income, or is it helping me build lasting wealth? You see, many entrepreneurs build successful businesses, but fewer of them intentionally build wealth. You see, business success and personal wealth are not the same thing, though they may feel like it at times. You see, your business can generate significant income, but unless you're intentional, my friend, about converting part of that success into personal assets, investments, and long-term wealth, you're simply just creating a bigger job for yourself. And one of the provisions receiving a lot of attention at this time is the creation of the Trump accounts. Now, before we talk why I think this matters, let's spend a minute just talking about what the Trump account is. You see, this account is really set up as a long-term investment account created for children under the age of 18. And look, for children that were born between 2025 and 2028, the federal government actually is going to provide a one-time $1,000 seed contribution if they're eligible. Now, after that one-time seed money, parents, grandparents, family members, and even employers can continue investing in this account. Now, generally contributions from, the private sources are limited to $5,000 a year. They're going to be adjusted, over the years by the inflation rate starting in 2027. The money is invested in qualifying broad U.S. stock index funds, giving it years or even decades to grow before the child reaches adulthood. Why does this matter? Well, I don't think this is the real story about another investment account. I think it really is the story about changing the timeline. And you see, Congress is now encouraging people to start investing earlier. And why do they do that? Well, you see, when it comes to money and wealth building, time is one of the greatest wealth building assets you'll ever have. Then I saw something else that really caught my attention as a business owner. The one big beautiful bill that this law allows employers to contribute up to $2,500 per year into this Trump account for an employee or an employee's qualifying child through a qualifying employer program. These contributions are generally excluded from the employee's taxable income, so they don't have to pay any tax on it. Now, you think about that. And as a business owner, now you've created another opportunity to invest in your employee's family. And it's not just through wages or benefits, but now you're helping the next generation. I'm going to say that again. You're now helping the next generation begin to build assets. They're teaching us to think in decades instead of quarters, because that's how wealth is built. It's built over time. It's not just by chasing the next opportunity. It's by giving good decisions enough time to compound. And that's why the leadership lesson isn't, should I open a Trump account? The leadership lesson is, what am I doing today that will create opportunities for the next generation 20 years from today? That's a completely different question, my friend. And I think it's a much better one, actually. You see, building wealth is important. But eventually, every business owner has to ask another question. Am I making decisions that create more options for the future? So I have to ask that third question. Every business owner needs to know, does it improve my future options? I love this question because it changes the way you think about tax planning. Most people think tax planning is about paying less in taxes. Now, don't get me wrong. Paying less in taxes is certainly a good thing, and that is one of the greatest joys that I get in helping business owners. But I think the real purpose of tax planning is really way bigger than that. You see, good tax planning creates options. I mean, think about that. It creates flexibility. It'll open up more choices. And as a business owner, options is what create and have tremendous value. One example of this option that's come out of this bill is the qualified business income deduction, often called the QBI deduction. If you're a business owner operating as an S corporation or a partnership or even as a sole proprietor, this is one of those provisions that may be one of the most valuable tax benefits that's available to you and perhaps that's ever been available to you. And this is why. The QBI deduction generally, what it does is it allows a qualifying business owner to deduct up to 20% of their qualified business income. Now, I want you to think about that. Look, this isn't another business expense. You didn't have to spend any money on it. You didn't have to buy any equipment. You didn't have to hire another employee. If you qualify, if you fall into the parameters of it, Congress is just simply going to allow you to deduct a portion of your business profit before calculating your business income. So let's just take a glance at a real simple example. So let's go with your business this year generated $300,000 of this qualified business income. So if you qualify for the full deduction, let's keep it simple in our example. A 20% QBI deduction could mean a $60,000 deduction. That's not a tax credit. It's a deduction that reduces your income that is subject to federal income taxes. For many business owners, that can translate into thousands of dollars of tax savings every single year. Look, there are important limitations, and there are some income levels that'll matter, and certain types of businesses that you own can really come into play there. There's some professional service businesses that face additional restrictions, once your income reaches a certain threshold. So this isn't, a deduction that just automatically applies to every business owner, but it brings back to the importance of focusing on and working with your qualified tax advisor so they can help you evaluate your specific situation. But here's what I want you to notice. For years, business owners weren't sure how long the deduction would last. Every few years, the conversation came back up. Should I change my entity? Is this deduction going away? Should I wait? Well, the One Big Beautiful Bill changes that conversation, my friend. You see, by making the QBI deduction permanent, Congress didn't simply preserve the deduction. It gave business owners something every leader values, and that's greater certainty. You see, greater certainty allows us to plan further down the future. It allows us to make hiring decisions with, greater confidence because we know what's ahead of us. Hey, it will allow us to invest with greater confidence. It allows us to structure our business with greater confidence. Look, and when leaders have greater confidence, they tend to make better long-term decisions. To me, that's one of the greatest gifts this legislation gives business owners. Look, my friend, it's not simply because of the deduction itself, but it's because certainty. Look, think about that. It's because certainty allows leaders to make better decisions. You see, great decisions aren't built by reacting every time the tax code changes. Look, they're built by creating long-term vision and then taking advantage of the opportunities that the tax code provides along the way. That's why I don't think of the biggest gift of the QBI deduction as a tax savings. I really see the biggest gift is the ability to build with greater confidence. You see, because certainty produces confidence, and it's confidence that will produce action, and it's actions that actually produce growth. And it's growth that creates the future that you're trying to build. So far we've asked 3 questions, Does this build more capacity? Does this build long-term wealth? Does it improve my future options? Now we come to the question that ties everything together. And the 4th and final question I think every business owner should ask is, does this strengthen both balance sheets? Now, if you've listened to me very long, you probably have heard me talk about what I call 2 balance sheets. Every business owner has 2 financial lives. One is the balance sheet of the business. The other is the balance sheet of the owner. Most entrepreneurs spend nearly all of their time focused on the business balance sheet, revenue, profit, cash flow, equipment, debt, growth. And man, all of those things are so important and they matter because you see, a healthy business creates opportunities. But here's what I've learned after working with hundreds of business owners. Successful business doesn't automatically create a financially successful owner. Look, I've met business owners with companies worth millions. I've met them worth hundreds of thousands. But the problem was they didn't have very much personal wealth. But I've met other owners with much smaller businesses who intentionally transferred the success of their business into their personal wealth year after year after year. That's the difference. The businesses generate the income, but the owners must intentionally convert this income into wealth, true wealth. Think back over everything we've talked about today. There's bonus depreciation, there's Section 179, there's the qualified business income deduction, there's the Trump accounts. Every one of those provisions can help you strengthen your business in some way, some form, some fashion. But look, here's a question I want to leave you with. Are they also strengthening your personal balance sheet? Because if every dollar stays trapped inside your business, if every tax savings is immediately spent, if every increase in profit simply creates more expensive lifestyle, look, my friend, you're just working harder without necessarily becoming wealthier. And that's why I tell business owners every chance I get when I have the opportunity to sit down with them. Look, your business is truly your greatest wealth building tool. Your business is your greatest wealth building tool. It should never become your only asset though. The goal isn't simply to build a bigger business. The goal is to allow the business to build a better life. And what does that mean? Well, that means intentionally moving wealth from the business to your family, into investments, to assets that will continue working for you whether you're in the office or not. Look, that's how businesses create freedom. That's how businesses create choices, my friend. Look, and ultimately, that's how businesses create legacy. You see, the tax code, it can help. Your accountant can help. Your financial advisor can help. But no tax law can make that decision for you. Look, you shouldn't even depend on your accountant or your financial advisor, because only you can decide whether today's success becomes tomorrow's wealth. So before you make your next business decision, before you buy that piece of equipment, before you hire another employee, before you chase the next deduction, I've got one final question that I want you to ask yourself. And that question is, will this, whatever it is that you're about to purchase or do, will this strengthen both balance sheets? Because if your business balance sheet grows, but your personal balance sheet doesn't, you may own a successful business without ever becoming financially independent. And I don't think that's why you started your business in the first place. So today we took a look at the One Big Beautiful Bill through 4 questions that every business owner should ask. Question 1, does this build more capacity? Question 2, does this build long-term wealth? Question 3, does this improve my future options? Question 4 is, does this strengthen both balance sheets? Look, here's what I hope you'll remember. Tax laws, they're going to come. Tax laws are going to go. Congress is going to change. Administrations are going to change. Look, the rules are going to continue to change, but great leadership principles don't. So don't let the tax code determine your vision. Let your vision determine your strategy. Let your vision determine where you're going. Then, once you know where you're going, you can use the tax code as one of the many tools at your disposal to help you actually build the future that you want. You see, my friend, at the end of the day, the greatest opportunity created by the One Big Beautiful Bill isn't found in the deductions. It's not found in a tax credit or a new account. It really is the opportunity to make intentional decisions that will strengthen your business, build lasting wealth, and create a better future for the people that you care the most about. So thank you for joining me for this episode of Growth and Wealth with Rodney Boswell. Look, if today's conversation helped you think differently about your business, let me encourage you to subscribe. Share this episode with another business owner. Visit us at ihsgroup.co for additional resources designed to help you build a healthier business and create lasting wealth. Till next time, my friend, keep building intentionally.